Looking at ahead to 23, we see several reasons for increasing allocations to private debt. First, interest income is at levels not seen since 2012. Second, the unrealized losses already in 2022 will either be absorbed in 23 realized losses and not affect 23 return, or realized losses won't happen and add another 2 to 3% in 2023, the point I demonstrated on the prior slide. Third, it's a lender's market, which makes deployment easy and loan terms very favorable. Fourth, if the worst happens and stagflation gets out of control, private debt returns will be muted but positive, as they were in 2022, but will likely again outperform stocks and bonds. Fifth, we're not excited about going opportunistic at this time. There's still a lot of uncertainty, okay, and timing is always difficult. We advocate to stay senior, preferably with sponsored borrowers and lenders with a solid track record of low realized losses. At the end of the day, direct loans generate attractive and consistent cash flow. Don't get in the way of that. If you look at slide 7, okay, in this slide, we connect likely returns for private debt with 4 possible economic scenarios for 2023. In all cases, private debt returns are good to very good. And except for scenario 3, private debt has a good chance of outperforming stocks and bonds next year. Slide 8, Phil. I wanted to comment briefly on the challenges of managing alternative funds, whether they be private debt, private equity, or real estate. This is particularly useful today as a few real estate funds are seeing meaningful redemptions. On this slide, we identified 5 keys to successfully managing any evergreen alternative fund. The first is liquidity. If you're going to allow redemptions, your fund better generate the cash flow necessary to meet requests. Income doesn't count because that is distributed separately, and neither do subscriptions, which you can't count on. Private debt checks the liquidity box. Second is valuation. Credible valuations are imperative, and this is made easier when you're dealing with a low-risk asset class in the first place. And private debt checks the valuation box. Third is leverage. When funds or managers get in trouble, you generally find too much borrowing. Fortunately, the use of leverage is an elective for private debt, so you go at your own risk. I would just note, again, that CDLI is unlevered, and many investors would be happy with just that. Fourth is transparency. If investors can't verify, how can they maintain trust? Fortunately, private debt is a very straightforward asset class with few restrictions on disclosing loan tapes. Fifth and final is the investor base, like the one on this call, that understands return and risk. And if the asset class performs in a way consistent with expectations, their horizon is long term.